In 1973, the stock market lost nearly 50% of its value. But there was no panic, no breaking news, and almost nobody remembers it today. Why? Imagine waking up one morning, checking your portfolio, and realizing that over the past year the market hasn't just dipped, it's been quietly bleeding out. No dramatic crash headline, no single Black Monday moment. Just a slow, relentless destruction of wealth. And by the time most people realized what was happening, it was already too late. That's exactly what happened in 1973. And the crazy part? Almost nobody talks about it. When people think about stock market crashes, they jump straight to 1929 or 2008. Big cinematic collapses, sudden panic, massive headlines. But the 1973-74 crash was different. It didn't explode, it suffocated the market, and in many ways that makes it even more dangerous. Because slow crashes don't scare you early, they trap you. Let me take you back. It's the early 1970s. The economy looks strong on the surface. The US had just come off a powerful bull market in the 60s. Confidence was high. Investors believed in a group of stocks so much, they called them the Nifty 50. These were the giants, the untouchables. Companies like Coca-Cola, IBM, and McDonald's. The belief was simple: buy them at any price, hold forever, and you'll never lose. Sound familiar? Because every generation has its version of this time is different. Back then, investors weren't just confident. They were convinced they had figured out the market. Valuations didn't matter anymore. Some of these companies were trading at absurd price-to-earnings ratios. But nobody cared. Growth would justify it, or so they thought. And then reality started creeping in. First, inflation began rising, not slowly, but aggressively. Prices were climbing, and the cost of living was increasing faster than expected. The Federal Reserve started tightening. Interest rates began to rise. Suddenly, the easy money environment that fueled those high valuations started to disappear. But here's the thing. Markets don't crash the moment conditions change. They resist. They deny. They hope. At first, stocks just stalled. Then they started drifting down. Nothing dramatic, just a slow grind lower. Most investors didn't panic. They held on. Because they believed in the story. And that belief is what made the crash so devastating. Then came the real shock. The 1973 oil crisis. OPEC imposed an oil embargo, and energy prices exploded. Overnight, economies around the world felt the pressure. Businesses struggled. Consumers pulled back. Inflation went even higher. Now you had a toxic mix: rising inflation, slowing growth, and tightening monetary policy. This is what we now call stagflation, and it's one of the worst environments for the stock market. But back then, investors didn't fully understand what was coming. The market kept sliding, month after month, year after year. By the time it was over, the S&P 500 had lost nearly 50% of its value. Let that sink in. Half. Gone. And it didn't happen in a single panic-driven collapse. It happened slowly, painfully, almost invisibly at first. That's why so many people stayed invested far longer than they should have. Because hope is a powerful thing in markets, and hope keeps you holding, even when the data is screaming at you to pay attention. Now here's where it gets even more interesting. The so-called safe stocks, the Nifty 50, the ones people believed could never fall, were hit the hardest. Some of them dropped 60%, 70%, even more. The lesson? No stock is safe at the wrong price. It doesn't matter how great the company is. If you overpay, you're setting yourself up for pain. And this is something modern investors still struggle with. Because we love stories. We love innovation. We love believing that certain companies are untouchable. But markets don't reward belief. They reward discipline. Back in 1973, The biggest mistake wasn't buying bad companies. It was overpaying for good ones. And when the macro environment changed, those high valuations collapsed like a house of cards. Now let's talk about something most people completely miss about this crash. It wasn't just about stocks falling. It was about confidence breaking. Investors who had been trained to buy the dip suddenly found that dips didn't recover. Each bounce was weaker than the last. Each rally failed. Over time, people stopped trusting the market. And when trust disappears, liquidity dries up. That's when markets become truly dangerous. Because without buyers stepping in, prices don't just fall, they accelerate downward. Now think about today. We've seen periods of low interest rates, high valuations, massive belief in certain sectors, and strong narratives driving prices. We've seen investors crowd into can't-lose trades. History doesn't repeat exactly, but it rhymes. And the 1973 crash is one of those rhymes that most people ignore, because it doesn't fit the dramatic story we like to tell. There was no single villain, no single day, no obvious turning point. Just a slow realization that things weren't what they seemed. And by the time that realization hit, portfolios were already deeply damaged. Another key lesson from that period is how long recovery can take. After the crash, the market didn't bounce back quickly. In fact, when you adjust for inflation, investors waited years just to break even. Years. That's something modern investors often underestimate. We've been conditioned to expect fast recoveries, quick rebounds, V-shaped rallies. But history shows us that's not always the case. Sometimes markets take their time. Sometimes they punish impatience. And sometimes they test your conviction in ways you didn't expect. So what can you actually take from all this? First, understand that not all crashes are loud. Some are silent. And silent crashes are often more dangerous because they don't trigger immediate action. Second, valuations matter more than stories. A great company at a bad price is still a bad investment. Third, macro conditions matter. Inflation, interest rates, and global events can completely change the game, even for the strongest companies. And finally, never assume that this time is different. Because every time investors say that, it usually isn't. The 1973 stock market crash isn't forgotten because it wasn't important. It's forgotten because it was uncomfortable. It forces us to confront the idea that markets don't always give clear signals, that risk doesn't always show up as panic, and that sometimes the biggest losses happen not in a moment of fear, but in a long period of misplaced confidence. And maybe that's why it matters so much today, because if you can understand a slow crash, if you can recognize the warning signs before the headlines, you give yourself an edge that most investors don't have. So the real question isn't just what happened in 1973. It's whether you'd recognize it, if it started happening again. And more importantly, would you act in time?